Hello, everybody. Welcome to the channel. My name is Bennett Tchaikovsky, the accounting professor. I this present that we're going to be going over today, we're going to be going over loans receivable. I did try to get this combined in with the loans payable, but it turned out to be a much longer video. So there you go. So we're going to be doing adjusting entries, and this presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without my prior written consent. Any opinions expressed herein are those of myself and not Irvine Valley College or the South Orange County Community College District. Any dad jokes or other humor is just humor. So take it at that. We're trying to make accounting fun again. So let's go here and take a look at our question. So over here for loans receivable. So LBJ loans PDX 400,000 and an annual rate of interest of 12%. The loan will be payable on July 31st, 2029. Assume that there is no interest on interest, and the amount of interest paid will be on the loan amount only during the time the loan is outstanding. So there's going to be no compounding of interest, right? But we do this specifically for these earlier types of questions. So the first part of this is it's a loan receivable. And when we're going through and looking at any type of T account, we've got our assets are equal to our liabilities plus our owner's equity. We use a T account. We put assets on the left, liabilities and equity on the right. We've got a debit, got a credit, and we've got expenses and revenues. Assets typically have debit balances. They're increased with debits. They are decreased with credits. Liabilities and equity typically have credit balances. They're increased with credits and then decreased with debits. Expenses are recorded with debits. Revenues are recorded with credits. The other thing, too, is when we are doing adjusting journal entries, what we are asking ourselves are these four questions. And this is actually really important, is that after we prepare the adjusting journal entry, do our revenues reflect what we have earned? Doesn't matter if the cash has been received, but have we earned that revenue? Do our expenses reflect what we have used? Do our assets reflect their future economic benefit? Do our liabilities reflect our future obligations? And when we prepare adjusting entry, we never touch cash. Now, this is a lower division financial accounting class, right? We're not doing high stakes poker of intermediate accounting. When we do high stakes poker of intermediate accounting, revenue has a very different meaning. I usually like to say at this point it's realize, realizable, and earn. But if we look at the bigger picture, there's a 5-step process. It's like, what's the contract? What are the performance obligations? What's the consideration? How do we tie the performance obligations to the consideration? And then we recognize the revenues as those performance obligations are done or completed. That's intermediate accounting. What we're doing here is lower division financial accounting. Also the same thing with the compounding of interest. Usually if you don't pay a balance, the interest continues to grow or compound. So coming over here, we have a loan receivable, right? So I am LBJ and I'm giving money to PDX. What is happening to my cash? Well, my cash is going down. And if this does not look familiar, meaning that if this is something that you haven't seen before, I have videos that I will go through and link below that you can go through and look at, right? When we're doing these initial entries, that's kind of what's happening, right? So on 8/1/25, I am crediting cash and I'm going to be debiting loan receivable because PDX will need to pay me back. So LR loan receivable. Okay, now that's all we do for this one right here. This should look very familiar to you because this right over here is what we've been doing previously. But what's different about this question? Well, what's different about this question are the dates, right? So the dates are a very important part of any bachelorette episode. But for us over here, dad joke one or terrible dad joke. So what we're trying to go through and do over here, though, as we kind of like look at this is say, okay, well, we're now going to prepare our financial statements on December 31st, 2025. So borrowing from some amazing charts that I made previously is we'll just kind of take this right over here. So if we look at this, we made a loan for the last examples was at year end. Therefore, let's just pull this up, pull this down over here. And here we go. Okay. So in our last examples, for the ones we were doing previously, prior to looking at adjusting entry, the loan in this case would have been made on 12/31/25, and we're preparing our financial statements on 12/31/25. Now, the reason why I did that is because if I said that the loan was made on October 1st and I'm making my financial statements on December 31st, we have a passage of time, right? So not quoting anybody, but we have a time has passed. And therefore, in this example, when we had a loan payable, we used the money. But over here, what we're going through and doing is we're not using the money. We've loaned the money out to someone else. So as we look at this example over here, right, we actually have in this case, and I'll just go ahead and make a new table. Let's go ahead and do this. So we are making our loan on August 1st, 2025. So right over here, we're making our loan on August 1st. And we are preparing our financial statements on December 31st, 2025. So unlike the example before, where we're just basically debiting loan payable and crediting cash, time has passed, right? So we have this period of time that has passed, okay? So what we're going to need to do is, because we've loaned money to somebody, and when we loan money to someone, they're going to pay us not only the loan amount back, but they're also going to be paying us interest. So what we have over here is kind of the inverse of a loan payable. We need to record interest revenue. Now, how do we record revenue? We're going to record revenue with a credit. So we're going to have interest revenue. So I'm going to record interest revenue. Not sure what that amount is going to be yet, but we will figure it out. So I'm going to record credit interest revenue. But what am I debiting? Well, remember our big rule. When we prepare adjusting entries, we never adjust cash. Also for this over here, right, for LBJ, there's no interest on interest, right? But the loan and the interest will be payable to us on July 31st, 2029. So what we're going to debit is interest receivable. Okay, so we're going to debit interest receivable to show the amount that we are owed. So we gave somebody money, even though they're not going to be paying us back from August 1st through December 31st. That amount has really, we've earned whatever that interest amount is. So let's go through now and compute the interest. So right over here, LBJ loans PDX 400,000 at an annual rate of 12%. So coming right over here, we've got loan amount is 400,000. So my loan amount is 400,000, right? So my interest rate or annual interest rate, whenever we see an interest rate, is always an annual rate, even if, unless it says otherwise. Annual rate of interest is 12%. So over here, so my annual interest, wow, Bennett, look at that spelling. There we go. Perfect. I don't great on spelling, by the way. Is $48,000. Okay, so that's the annual interest. Now, when it comes to this, right, we've got 48,000 of annual interest, right? This is for 12 months or a full year. In our case, the loan, our year ends December 31st, 2025. It began on January 1st. We're a calendar year company. So how many months has the loan been outstanding for? Well, we've got August, September, October, November, December, or 1, 2, 3, 4, 5. So for 5 months. So when I multiply this by 5/12, or to reflect 8/1/25 through 12/31/25, 48,000 times 5 divided by 12 is going to be 20,000. So the amount of interest revenue I'm going to recognize, or my adjusting entry, is going to be $20,000. Okay. So right over here, prepare the adjusting entry as of 12/31/25. Okay. So now this next question, we kind of looked at a similar type of scenario when we were coming over here, and I'll just move this down a bit. So how are interest in the loan classified on LBJ's balance sheet? Well, what is a balance sheet? Or we basically said a balance sheet is effectively, it is our assets are equal to our liabilities plus our owner's equity. But we're now getting a little bit more advanced when we're talking about adjusting entries. So when we go over here to sec.gov, we decide to come over here and we say, okay, we're going to search some filings and we're going to look at our friends at Apple. Uh-oh. Hopefully they haven't gone out of business, and they have not. I don't know why it's been glitching. Okay. So when I look at this over here for Apple, I go to their balance sheet, right? So total assets equals total liabilities plus owner's equity, right? But what you notice here is when it comes to this balance sheet, we call this classified. Does not mean that it is top secret. Rather, what it means is that we're going to separate our assets into current and non-current. I'm going to keep them separated. Okay. Very, very bad. Well, very catchy. I think it was like a 90s tune. And then for liabilities, we're also going to separate them into current versus non-current. You will sometimes hear somebody say long term. However, when you go to sec.gov, which pretty much the place you want to go to, they're going to call it non-current or anything that's not current. What does current mean? Well, for an asset, it means we're going to be receiving it within the year. What does non-current mean? It means it's going to be not going to be receiving it or be using it or has a longer period of life. So that would be a non-current asset. Similarly with liabilities, if it's a current liability, it's going to have to be paid or satisfied within the year. If it is non-current, it's going to be beyond 1 year. So when I look at this question, how are these going to be classified on the balance sheet? So we've got 12/31/25. We've got 12/31/26. 12/31/28, and then the loan will be paid back on 7/31/29. Okay, so the loan is due here. So when I look at this, right, what I'm really kind of saying is, okay, in order for something to be current, right, as a current asset, it has to be payable within this next period. So as of 12/31/25, in order for this to be a current asset, it has to be basically paid to me here. So on 12/31/25, the loan receivable and interest receivable will be classified as non-current, as a non-current asset. Why is it going to be classified as a non-current asset? Because it's beyond 1 year of the balance sheet date. Let's go to the next year. On 12/31/26, the loan receivable, right, basically right over here. So when we look at this, we'll kind of go through and just go ahead and code this green. We'll go ahead and code this yellow. And so as of 12/31/26, in order for it to be classified as current, it would have to be, as a current asset, it would have to be repaid to me within 1 year. That's not the case. Still, the loan's going to be due out here. So in this case over here, same issue. Okay, so what about 12/31/27? Well, we're getting a little bit closer. However, it's still beyond 1 year. So on 12/31/27, it's still going to be the loan payable, excuse me, the loan receivable and the interest receivable, because remember, the interest is not going to be paid until the loan is satisfied, will still be non-current. Lastly, on 12/31/28, this is where it becomes a current asset, finally, after all this time. In this case over here, right, the loan receivable on 12/31/28 will be classified as a current asset because the loan receivable will be paid to us within 12 months of the balance sheet date of 12/31/28. So that's how we would go through and answer that question. Okay. Now, extra credit. How would we go through and prepare the adjusting entries on this and the loan repayment? Well, basically what's going to happen is if we kind of look at this, we're going to bring down some accounts, right? So on 12/31/25, right, for the interest receivable and interest revenue, and then we also have the loan initially, or the loan receivable. Okay, and this was going to be 400,000. Okay, so when I go through and look at what happens in the following year, right? Well, as we know, basically interest revenue, any revenue, expense, or a dividend is what we call a temporary account, meaning that it's going to be closed out to retained earnings at the end of the period. But in this case over here, for interest receivable as well as our loan receivable, those balances will carry forward for a longer period of time. So when we look at our balances, right, if we're going to 2020, well, what happens in 2026? Well, this is going to be closed out to zero, right? So basically on 1/1/26, the revenue is going to start at zero. However, our interest receivable, the ending balance of 2025 becomes the beginning balance of the following period. Similarly, over here on 1/1/26, ending balance of 12/31/25 becomes the beginning balance of 1/1/26. Now, for 2026, what happened? Well, we had a full year of interest, right? So the loan amount was 400,000. My interest rate was 12%. So annual interest is going to be 400,000 times 12 or $48,000. So what we're going to see happen is that basically for the next period of time is that what we're going to see is that this journal entry is going to be repeating itself. So we're being asked to do 12/31/26, 27, 28, and then the loan repayment on 7/31 will be 29. And then ask for the loan repayment on 7/31/29. So in 2026, this is going to be 48,000. I debit interest receivable and I'm crediting interest revenue. Right? This is my adjusting journal entry, right? Why am I doing this? Well, another year has passed, and so more interest has been earned. To go through and show the earning of interest, we're going to call this a revenue. Sometimes we see it referred to as interest income, but because it's a revenue, it's going to have a credit balance. Over here, we're debiting interest receivable. It's going to have a debit balance because it's an asset. Just remember over here, when it comes to adjusting entries, basic entries, right, is that for interest, if we have a loan receivable, it's going to be a debit to interest receivable, a credit to interest revenue. So now coming over here, our ending balance of interest receivable is $68,000, right? And then over here, our loan receivable has not changed, right? This is going to remain static. This revenue account is going to get closed out at the end of the year, and then we would start fresh the following year. So let's go to 12/31, let's go to the next year because we have to do this for a few more years. So this is going to be 1/1/27. Our opening balance on 1/1/27 is going to be 68,000. 1/1/27, our opening balance and interest revenue is going to be zero because we closed out revenues, expenses, and dividends, because those tell us what we earned or used or paid out as a dividend or declared as a dividend over a period of time. The loan receivable balance, just like all assets, liabilities, and certain equity accounts, is just going to roll over. Coming over here, so the amount of interest I've earned, it's again for 2027, it's another 12 months. So for my adjusting journal entry for 2027 is going to be another 48,000, right? I've earned another $48,000 of interest. So my ending balance as of 12/31/27 is going to be 116,000 of interest receivable. So my loan receivable is going to have an ending balance of 400,000. Nothing really happens there. Let's go to the next year. So coming over here to the next year, my opening balance on 1/1/28, remember, ending of 1 year becomes the beginning of the following period. So over here, 1/1/28. And so coming over here, my adjusting journal entry for 28, remember the loan is not going to be repaid until 2029. So coming over here, so I've got basically my adjusting entry. Again, it's going to be 48,000, 48,000. Loan receivable has not changed. Okay. Now, when we get to this next period of time, this is basically when the loan is going to be repaid. So 1/1/29. So the amount that is due on the loan is 164,000. Okay. So in 2029, so I'm sitting right here in basically the month I'm sitting in right now. This is 1/1/29. The loan, and by the way, if you're taking my class, this is extra credit. I'm doing this so to kind of show you how these kinds of things work. It's important to understand it. So the loan is going to become due on 7/31/29. And if I receive a payment from basically from PDX, well, we got to go through and do a few things. The first thing I have to go through and do is I need to record interest that I've earned during this period of time. How do I go through and record it? Well, the loan amount is 400,000. My interest rate annual is 12%. So my annual interest is 48,000. However, in this case, I've got how many months of time? January, February, March, April, May, June, July. I've got 7 months going on. So over here, I'm going to multiply this by 7/12, or from 1/1/29 to 7/31/29. And this is going to give me 28,000 of interest earned. So what I can do is I can say over here, basically, I'm going to basically credit interest revenue or 1/1 through 7/31/29. I'm going to debit interest receivable over here for the 28,000. So whenever I pay back or when I'm receiving a loan, I need to accrue interest up until the date of repayment. Now, when I come over here, PDX is going to pay me back. Well, how much are they going to go through and pay me? Well, they're going to not only pay me, they're basically going to pay me a total of 592,000. The $400,000 for the loan, and then they're going to pay me the interest. Okay. So how do we go through and record this? Well, on 7/31/29, right? When I'm getting cash, the amount of cash I'm going to be receiving is going to be for the amount of the loan, or 400,000 plus the accumulated interest of 192,000. Over here, I'm going to credit. When they pay me back, do they owe me this interest? And the answer is no. So what I'm going to go through and do is I'm going to go ahead and credit interest receivable for 192,000. And at the same time, they don't owe me this $400,000 anymore. So what I'm going to go through and do is I'm going to go ahead and credit the loan receivable because it's no longer owed to me. They've paid it back. So my loan receivable is going to be credited for $400,000 to record repayment of the loan. Okay. So again, interest receivable had a balance of 192. Now that it's being paid off, I'm crediting it. I need to make sure that I indent the journal entry. Okay. And I can do it this way because I've already recorded the interest, right? So if I look at this, this is really in 2029, this is really 2 journal entries. It's 7/31/29. I'm debiting interest receivable of 28,000, and I'm crediting interest revenue of 28,000 to record interest earned from 1/1/29 to 7/31/29. So this is really 2 journal entries that are taking place. Now, you might say, well, Bennett, I want to do something that combines them into one. Can I combine these 2 journal entries into one? Sure. You're going to get the same answer, but what would that be? So 7/31/29, if I were to combine them, I would be getting cash of 592. That's not going to change. The loan receivable is also going to remain unchanged at 40. The interest revenue is also going to be at 28,000. However, the interest receivable, because I'm combining these entries, is basically going to be 192 less the amount I initially accrued over here, or 164. And whenever I do this, I want to make sure that my total debits equal my total credits. So there's a lot of different ways you can approach these problems, and that's what makes accounting kind of fun sometimes. But well, accounting is always fun. But it's one of these things that as you're kind of going through it, the best thing I can give you suggestions on is to kind of go through and visualize it. Again, if you're taking my class, the only thing I'm really going to be going up through and having you kind of do is basically is up to kind of like up to here, kind of maybe understanding like what the loan would be classified in the future as. Um, that's all I'm really going to be asking you. So again, this down here, I consider to be more advanced because there's additional computations that are going through and being involved, but who knows? And if you would like to see more of these questions, please feel free to reach out to me. I want to thank you for watching today. Please don't forget to like and subscribe. And I look forward to seeing you on future videos. Have a great day.